Emerson Electric is a dividend king that has increased its dividend for 65 consecutive years. That the bear market is bringing us the future opportunity to be able to build a position in. As you can see, the stock is still not yet trading at what I would call fair value, but it's getting close. Tune into this video and let me give you an explanation of why I think this stock will soon be available for purchase, as well as 5 additional dividend kings that you're going to like. Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, and I'm proudly bringing you part 2 of my 3-part series talking about the opportunity that comes with investing in bear markets. In part 1, which I will include a link to in this video, I talked about how bear markets tend to be a lot shorter than bull markets. Bull markets tend to last a lot longer than bear markets. So we're in a bear market and we're starting to see some incredible opportunities, especially in the dividend growth stocks. And I want to go ahead and revisit a quote that I shared with you in part 1, Dividend Growth Stocks for Safety and Income, the intelligent investor Ben Graham. Dividend record, one of the most pervasive tests of high quality, is an uninterrupted record of dividend payments going back over many years. We think a record of continuous dividend payments for the last 20 years or more is an important plus factor in the company's quality rating. Indeed, the defensive investor might be justified in limiting his or her purchases to those meeting this test. Ben Graham, well, what we're looking at here is an A-rated dividend king. Now, as a dividend king, it's also a dividend aristocrat and a dividend champion. It's a semi-cyclical company, but a very high-quality electric components and equipment company. It's had good comparable 5.65% growth. It is historically traded between a 15 and an 18 PE and sometimes even higher. On the rare occasion you get a chance to buy this stock at a PE of 15 or below, like you can today. Today you can buy it at a blended PE ratio of 16.58, but it's on its way to getting close to that 15 or below PE. The bear market I don't believe is over yet, but this is a company that's getting very close. And so I'm going to cover it and 5 additional companies that are all dividend kings that I call dividend kings getting close to being buyable in this market. And so what I'm suggesting is you would want to patiently wait for each of those to come. So going back to Emerson Electric, I've switched now to free cash flow. That's a real hallmark of these dividend kings where their free cash flow, the orange line on this graph, is well above the dividend, which is the white line on this graph. This company has the ability to generate a significant amount of free cash flow, which is why their dividend record is so stellar. If 20 years, represents extreme quality, just think of what 65 consecutive years means to you as an investor. From a standpoint of going forward, this company is expected to grow cash flows at about 7.5 or 6%. If you looked at their normal multiple of cash flows, it would look actually undervalued today. If you're looking at what I would call fair value of free cash flow, it would be slightly overvalued. But the point is, it's very close. It does not quite yet give me the margin of safety that I'm looking for. I also want to point out that like most companies in this bear market, we're seeing situations where for this year's fiscal earnings, we're seeing the earnings kind of steadily drifting downward. We're expecting 504 for this year end. Next year, we're expecting 560. A few months ago, analysts were expecting 554 and then up to 564. So that's only a slight decrease. And then, in 2024, we're looking at 6 to 18 a share, which is the highest estimate. So this company, which does have some basic cyclicality, is starting to look real good. The analyst scorecard in this company is close to being impeccable. In other words, analysts have been able to get this one right most of the time. So that should give you, a great deal of comfort when you're looking at this stock. Now, I would like to see it cheaper. So let's talk about how much cheaper, because that's what I want you to understand. I would like to see this stock, trading to $60 and $68 a share. At $60 or $68 a share, I think the stock has become very, very attractive. It's currently trading at 80, so it would have a little way to go. That would give you a margin of safety in the stock, but I consider it a stock that's getting, a dividend king that's getting very, very close to fair value. I would be patiently waiting, yet it's not quite there. The next one would be Fuller Brush Company. Now, Fuller Brush Company is also very, very close. Now, you can see most of the time it trades at a 15 PE or higher. It's another example of a really high-quality dividend-paying stock that is actually a dividend king In this case, the company has increased their dividend for 53 consecutive years. Not quite as good as Emerson Electric, but close. And once again, you can see it's recently gone from being overvalued to fairly valued. As I look at the cash flows of this company, I don't get quite the stellar record I saw with Emerson Electric, but I get a very, very good record. And then the ultimate, free cash flow test. I did have a year or two where the free cash flow fell below, but generally speaking, they're covering their dividend with free cash flow, and their free cash flow is expected to grow dramatically. This is a double B rated company. It's had a dividend streak of 53 consecutive years. So it's not quite the quality of Emerson Electric, and it's getting close to being a good buy, but it's not quite there yet. So I'd be waiting on this one a little bit. The next one I want to take a look at is Parker Hannifin. It is an investment grade triple B plus rated company. This one technically and arguably would be cheap enough to start taking a position in today. Looking at forecasting, it does give you a very slight margin of safety, but I would like to see a higher margin of safety, although it looks safer when you look at how the market likes to put a premium valuation on this company. That's maybe great. The market isn't shy about putting a 15 or 16, but 15 times earnings is what I really consider as a solid valuation for this company. Currently trades at 13.5 blended PE, earnings yield 7.37%, dividend yield 2.14, and it's got plenty of growth potential going forward. So, I like this company if you look at its performance, over time. And I'm going to take a moment here. This is that new feature we're going to be given. And again, this isn't quite working as good as I'd like to see it working, but you can go into the comparison ticker file here under settings, go ahead and add whatever symbol you want to compare the company with, and I'm going to compare it with the S&P 500 ETF, the SPY, and go ahead and save the changes here. And you can see that it's dramatically outperformed the market. That's really, been excellent. This is a super company. It's got great performance, great growth, grown about 11% a year, even though it's trading at a discounted value right now, especially compared to the market. You can buy this stock with a 2.1% dividend yield that's, again, grown for 53 consecutive years and really do quite well with this company. The next company on the list is PPG Industries. Again, it's another one that the market does put a premium valuation on it of around 17 or 18 times earnings historically. It got way above that in 2021, summer of 2021. It's coming very close to fair value now. If I look at it from a forecasting standpoint, it's within the fair value range. But given that we're in a bear market, I don't think it's cheap enough. Based on an 18 to 20 multiple, the company does have a slight margin of safety built in if you were willing to believe that, the stock was going to continue, to do that. So I could put in, lower PEs if I want. But the point is, right now this stock is getting real close to being buyable as well. Now, looking at PPG compared to as a Dividend King, it's a company that has increased their dividend for 50 consecutive years. Again, that's a whole lot better. It just means it just became a Dividend King. That's a whole lot better than 20 or even 25, like your Basic Champion or Aristocrat. Companies that are capable of doing that are companies that you can have a great deal of confidence in. I definitely agree with Ben Graham that this really is a testament to quality. Operating cash flow is well covering the dividend, as well as free cash flow is well covering the dividend. So, a little bit of patience here could go a long way and give you an opportunity to buy PPG Industries. The next one is Stepan Co. Now, it's a non-rated company. It does not have the free cash flow that I've seen with all the other companies. However, the operating cash flow does cover the dividend. If I look at this one from a standpoint of what their historical record has been, I don't have that number for you, but the point is it's increased its dividend for over 50 years consecutively, and it's got good earnings growth and it's come into fair value. This is one that's buyable today, but I think you'd be better off waiting to see it. From a performance point of view, it's been a stellar outperformer of the market, generating 11.8 versus 8.54. Significantly more dividend income as well. So this would be one that you would want to take maybe a closer look at. The next company on the list would be Target. And Target, as you can see, has kind of been in a slump. When I look at the historical numbers, there's a couple things I want to point out. Target did very well post-COVID. Their earnings growth surged for a couple of years, but now they're hitting a wall. They're really stuck with a lot of excess inventory. Management might have got a little aggressive. Consequently, the stock has corrected. Earnings are expected to be down. If I look at it from a standpoint of operating cash flow, I can look at operating cash flow is also expected to be down, but I think it's trading at its normal operating cash flow, but it does cover the dividend very well. And for the most part, they've also covered the dividend with free cash flow. So if you're a long-term investor, and I really want to make this point here, if you're a long-term investor, if you're willing to own this stock for the next 5 or 10 years, this is probably going to be a good entry point. Now, you might hit some problems for the next couple of quarters. That's something that you really need to take into consideration. But once this stock starts growing again, which is expected to grow double-digit rates over the long run, this could end up being an opportunity of a lifetime, one of those, monumental times where you can get a chance to buy an extremely high A-rated company at an extremely attractive valuation for the long-term results. Now, I talked about comparing performance. This is the new feature we're offering. So I could go out and, for example, compare this with Walmart, for an example, and I'm going to do another one in part 3 of this series. By the way, I don't think I announced it in this video. This is the new version of Fast Graphs that will be launching in about the first week of August. As you can see, I've still got some bugs to work out, but we plan on getting those bugs worked out here pretty quickly. And I've not been able to get Walmart loaded there. So we'll pass on this till we get to the next video. But anyway, these are basically Dividend Kings that I think are very, very, getting very, very close to being very attractive. They're not quite there yet. We have 6 companies here as an example that are moving, into fair value territory. One thing I would like to point out, and before I close this video, which I'm going to go ahead and do now, my point is I don't think it's time to chase these stocks yet. I think what you're seeing is these stocks are coming to you and you want to be patient. Now, like, Buffett said, you want to be fearful when others are greedy and greedy when others are fearful. I don't quite think it's time to be greedy yet. I do think that we're looking at a lot of people that are being fearful. But if you go through the Dividend Kings list and look at the list, you're going to see a lot of really great names. I'm just going to breeze through some of these that are showing signs of suffering from the bear market, that are starting to come down, but I don't think they're quite there yet. The 6 that I've shown in this video are getting very, very close. So you might want to make a list and watch those. When you can get them with a margin of safety, you might want to invest. Anyway, this has been Chuck Carnevale, aka Mr. Valuation, bringing you part 2 of my series on the opportunities brought to you by bear markets. Hope you enjoyed the video. If you did, give me a like, ring the bell, subscribe to the channel, and also take a look at subscribing to Fast Graphs. I can't even imagine investing without it. And by the way, just to be clear, I have included the link to part 1 below so you can watch, part 1 and part 2 of this series. Thanks for watching.